Hey, it's BN with Realty One Group, and glad you came back to my Home Buying 101 video series. In our last video, I talked about credit reports and credit scores and getting that all, taken care of in relation to home buying. And so now I'm going to be transitioning to financing. And financing is a really big part of the home buying process, so I'm going to break it down into 3 different videos. If you haven't subscribed to my YouTube page, take a second to do that right now. Now, today's financing topic is pre-qualifying versus pre-approvals, what's the difference, and what you should know about it in the home buying process. You're excited, you're ready to go view some homes, but before you go, you want to start talking to a lender about financing. Depending on the lender, you're going to want to get pre-qualified or pre-approved. And FYI, I have a couple of lenders I work with, and I have provided their contact info for you in the descriptions area of the video, so make sure to check it out. Now, I mentioned pre-qualification and pre-approval, and some folks may use these words interchangeably. You may be wondering what's the difference and why should I care? So let's first talk about pre-qualification. For many lenders, it's a quicker process. It doesn't require as much documentation as a pre-approval, and it's normally based on a person's credit score. So we talked about those credit scores previously. They also look at the total assets, available down payment, and income that's disclosed during that conversation. So as I shared, it doesn't really require as much upfront documentation. Based on that discussion, the information the buyer provides, the lender then provides an estimate in writing that states how much they think the borrower can afford to pay for a monthly mortgage loan. So at that point, there's no cost involved, there's no commitment on either side, the buyer or the lender, and it can take as quickly as 15 minutes to get a pre-qualification letter, or as long as a day or so. It just depends on the lender. So if it's not binding and just an estimate, then why get pre-qualified, you might ask? Well, first of all, it saves you time. You aren't looking at properties that are too expensive, you have a target range that you know about. And secondly, it allows you, the borrower, to move quickly when you do find a home that meets your needs, because you've already got that lender contact. You've built that relationship. And then thirdly, it allows you to look serious to a seller. They want somebody who has their finances in order and are serious about the home buying process. So a pre-approval process, on the other hand, has the same benefits, but it's more extensive in the process. Normally in that process, a lender is going to request documentation like your W-2s, documentation like employment verifications and copies of your bank statements and pay stubs. They may even ask for your retirement assets and so forth. So it's a stronger estimate than a pre-qualification if the lender chooses that route. However, there is a caveat, and in both situations, whether it's pre-qualification or pre-approval, this doesn't immediately identify potential issues or red flags that during the underwriting process can prevent a loan from closing. At best, it indicates that the lender is interested in providing financing to you, and it helps, sway the seller to consider your offer. It can, unfortunately, provide almost a sense of security, false sense of security for both the buyer and the seller. Now, you might be asking, well, what are the red flags? So here's some common ones, and they're not limited to, but they could include things like, somebody's credit report. There may be disputed accounts, collection or judgment accounts that person's dealing with, deferred student loans, that can add on to somebody's debt, late payments, those are things that I talked about previously. Not long ago, I actually had a situation where a buyer, some of their debt ended up popping back up, and that unfortunately ended up, the buyer wasn't able to be approved now because of that extra debt that popped up from the past. Income situations are red flags where somebody, if they're self-employed for less than 2 years and don't have stable income, maybe they have tax returns that have Schedule E losses, for example. Maybe there's alimony payments that are inconsistent, other inconsistent of supplemental income that they're using to provide as a base of their source of income for their total, monthly income or annual income for the home. When it comes to assets, red flags could be things like large cash deposits. The lender's going to want to know, where did this money come from and why it's not a part of your regular income. And of course, things like closing costs. Do you have the money to close? So I hope this information has been helpful. And if so, please hit the like button and subscribe, because I definitely have more videos coming up. And don't forget that I have lender resources in the description page. So thank you for watching, and I'll see you next time.